If the tax deduction disappeared tomorrow, would you still buy it? If the answer is no, we need to talk. Hi, I'm Sherry Aylen, CPA and tax advisor, and I help my clients pay little to no tax using my zero tax blueprint, but not by buying stuff they don't need. Stay with me. I was recently having dinner with some of my clients and their friends, and we were talking about tax strategy. There are various ways to reduce your tax bill, but a phrase that has come up a bit recently and every serious investor should have tattooed in their brain: don't let the tax tail wag the dog. Here's what I see all the time. A client finds out about 100% bonus depreciation, which, thanks to the one big beautiful bill, is now permanent, and they immediately start shopping for a $90,000 truck. Why? Because someone told them they could write off the whole thing in year one. And technically, that's true. But is that truck a good investment? A depreciating asset, a vehicle, goes down in value the moment you drive it off the lot. You get the tax deduction once, and then you own a depreciating liability. Now compare that to a rental property or a short-term rental, something that produces income, builds equity, and also has tax benefits, potentially for years. That's the dog. The tax benefit is just the tail. So let's use some real numbers. Say you buy a $90,000 SUV that qualifies, over 6,000 pounds gross vehicle weight, used more than 50% for business. Under bonus depreciation, you write off the full $90,000 in year one. If you're in a 30% effective tax bracket, that saves you about $27,000 in taxes. And that feels amazing. But what did you actually buy? A vehicle that's worth maybe $65,000 the day you drive it off the lot, ongoing insurance, maintenance, fuel, and when you sell it, depreciation recapture. The IRS wants some of that money back. Your $27,000 tax savings came at the cost of a $90,000 outlay. The net isn't as pretty as it looks on paper. Now, I'm not saying never buy the truck. If you need a heavy vehicle for your business, buy it and absolutely take the deduction. That is smart tax planning. The problem is buying it because of the deduction. Now, let's look at the other side. You buy a $300,000 rental property. Let's say $240,000 is allocated to the structure, the depreciable portion. Under straight line depreciation, that's about $8,700 a year in deductions over 27 and a half years. But what if you do a cost segregation study? You accelerate a chunk of that into 5, 7, and 15-year property, and with 100% bonus depreciation now permanent, a significant portion can be written off in year one. Well, let's say you front load $80,000 in deductions in year one, same tax bracket. That's $24,000 in tax savings. But here's what's different. That property is still worth $300,000 or more if it appreciates. It's generating rental income. You can refinance it, pull equity out tax-free. You can 1031 exchange it someday and defer the gain. Or hold it and pass it to your heirs with a stepped-up basis. The tax benefit and the wealth are both working for you at the same time. That's letting the investment wag the dog, with the tax as a bonus. So here's the 3-question framework I use with my private clients before we ever talk about tax strategy. Question 1, is this a good investment on its own merits? If the tax deduction disappeared tomorrow, would you still want it? If the answer is no, that's a red flag. Question 2, does it produce income or build equity? Assets that put money in your pocket, rental income, business revenue, appreciation, are the foundation. But tax deductions on top of that are the accelerant. And question 3, what's the long game? A vehicle depreciates. Real estate, a business, intellectual property, those can compound. Tax planning should extend your long game, not distract from it. Write those 3 questions down. Ask them before every major financial decision. And one more question I would ask myself or my clients is this something that you enjoy? A business that you would like to get into that actually also has a tax benefit by having depreciable assets or even other special deductions or tax treatment that would apply? If so, then you have the best of both worlds. The one big, beautiful bill just made bonus depreciation permanent. That is genuinely a massive win for the real estate investors and business owners. But the best investors I work with, they're not running out to buy depreciating assets just to chase a write-off. They're buying income-producing real estate, building businesses, and then layering the tax strategy on top. The tail doesn't wag the dog. The dog runs, and the tail comes along for the ride. If this has been helpful, like and subscribe to the channel, and check out my other videos on my real estate strategies for tax savings. I will see you next time.